3, 2, 1.
All right.
Welcome to the Grow My TSP weekly podcast.
Element
That's a mouthful.
June 9th. It's my brother's birthday.
Oh, awesome.
Yeah.
Stepmother's birthday was yesterday, and I need to call her today because I messed up.
Yep.
If you're watching, I know she's not.
Happy birthday.
She's not even on the internet. Much less
You don't have to worry about that.
Yeah.
Oh, boy.
Well, if there's any birthdays out there today, happy birthday.
Yeah, absolutely. Dude, crazy market. Like last week, super volatile. This week, the volatility continues. But at the end of the day, the market just keeps ticking higher. The bears are trying to push it down, but the bulls are just like pull it back up by the end of the day, and that's that.
I know. Right before we came on, we were just looking at the past few weeks, and yeah, it's just crazy. I mean, it's sometimes. I mean, I find this a very hard time. If it wasn't for the methodology that we use, I'm not sure how I'd wrap my head around the market because it's just been going sideways, and you can't tell it's going sideways till after it's gone sideways.
Right.
So that's the hardest part, right? It's easy to see upward and downward movement, but not when it's doing like this, because it could potentially either way keep going, right? But then as it unfolds, and as the aperture goes back or whatever, you're like, oh, that was just sideways.
Yeah.
And sideways market's horrible because you can't really make any money.
Yeah.
And you don't know where this is going to go,
The sideways part is bad if you're just looking at closing price. But if you're watching it throughout the day, holy moly, there's been some wild swings.
Yeah, it's even worse.
So basically what we're going to do on this show is kind of not worry about the micro, like the myopic stuff. We're going to kind of spread it out a little bit.
Bueno.
And see what we see. So risk on versus risk off.
Let me put something out real quick while everybody's watching it right now. So as you guys see that the camera switches to Jerry's, presentation and the things he does, and then you got your little guy up there in the left. Is there any better place for that in the screen? Put that in the comment section, because I had someone say that they'd rather have it on the right, and I was like, I don't know that it makes any difference. But if you guys, I would definitely get some feedback, because as the producer of this show, like it's hard. First of all, just doing all these camera changes while I'm talking and doing all that, it's definitely good that I have massive ADD. But yeah, nobody ever really comments on that kind of stuff. But if you guys have any feedback, particularly on anything, honestly, it doesn't always have to be about the market. If you guys think we can put together the production of this show, I'd love to get that kind of feedback. I thought it was kind of cool that they put the time to say, hey, what if you did, one of the things I would like to do is not make it a rectangle like that, but unfortunately the software we use doesn't give me any options. I'd like you having a circle, but that's just me. All right, go ahead. Back to the show.
Get me off track here, bro. All right. So risk on versus risk off. You hear that quite a bit in the media, and it's kind of straightforward, right? If risk on means that generally people are willing to take risks for whatever the underlying conditions are in the market, and risk off is people don't want to invest, and they tend to do it in like Bloomberg and CNBC, like on a day-to-day basis. Like, investors were risk on today when the market did X, or risk off when the market did Y. It's not really helpful unless you look at it on a longer term and understand what it means. So I got a really good chart that kind of shows risk on, risk off. Credit spread, another thing that a lot of people are talking about right now, but it's not hard to understand, but we got a chart on what exactly credit spreads are and why they can tell us which way the market's going. And then initial jobless claims, in my opinion, is there's a lot of different metrics you can use in terms of unemployment and jobless claims. Initial jobless claims is a good one, and we'll do a chart on that. Basically, this whole thing, the continuation of this bull market, or the eventual completion of this bull market, let's put it that way, is gonna be when people start losing their jobs. That's what's going to bring the whole thing down. You can have all these little ups and downs in the meantime.
You heard it here first, folks.
Yeah, no, it's you may not have heard it here first, but you're hearing it here now. That's what's going to be the thing that really pushes it over the edge. And then I think I did TNX 10-year yield last week. I don't know if it was the bonus chart, but I definitely did it in the podcast somewhere. And I'm just going to do a kind of an update to that. And then it's, I think June 1st was like Sunday last week, so it was too late in the weekend. We had done the podcast earlier, so I didn't have the full monthly candle, so I'm going to do the monthly charts this week. Okay, so risk on versus risk off. So this is a really good indicator. XLP versus NYA. So XLP is consumer staples, right? It's things that you need to buy, whether the market's going up or down, right? So it's another way to say it is it's defensive stocks, not defense like military defense. It's defensive like toilet paper and things that you need, whether the market's going up or down. So as people get more concerned about the direction of the market, they tend to invest in companies that they know will go up even if the market's going down. And so it's a risk off. Okay, so when XLP relative to NYA, which is New York Stock Exchange, so it's basically all stocks in the New York Stock Exchange, when XLP is going up relative to all the other stocks, it's a risk off environment. So if we look at it on a chart, it kind of tells us. So this is a weekly chart, okay, and we're going back to, it was 1999. So it's not a timing tool, but it definitely tells us kind of the direction of the market. So the ratio is coming down as the market's going up into the top in 2000. At some point, the ratio turns, right? And the ratio starts going up, which means people are buying more of XLP relative to the whole market. And that ratio starts going up even as the price of the S&P continues higher. Okay? So it's a red flag, right? Because while the price of the S&P is still going up, the ratio of investors investing in defensive products is going up. And so it's telling you that the top is coming in the S&P, and that's what happens in 2000. The ratio keeps going up as the market keeps falling. And then the reverse is also true. As like if you had connected that trend line, you get a double top in the ratio. Once the trend starts going in the other direction, so less people are buying defensive products, that's happening before we actually get to the bottom in the S&P. So it tells you on the front end that the top is coming, and it tells you on the back end that the bottom is coming. So it's not a timing tool, but it's a really good indication of the longer term direction of the S&P. It's the same thing down here in 2007. The ratio bottoms and starts turning up as the market is topping, right? Market rolls over, the ratio keeps going up, the ratio starts to roll over, and that's where the bottom is in 2009. So it's a really good timing tool. And so you can look at it all the way through all the major turning points. And where we are right now is kind of frightening, to be honest. We've got a really good channel, right, from 2023. The ratio is going straight down in a really tight channel. And so this uptick that we've had over the last several weeks, even as the market keeps going higher, is definitely a red flag. Okay, the market is getting generally more risk off. It's possible that this reverses and keeps going down, but for right now, we haven't been outside of this really tight channel in over a year. So we'll see what happens, but it's a big red flag for me. Okay. Credit spreads. So credit spread, if this is the high yield index option adjusted spread, and this is the S&P 500 down here. So what that means is high yield bonds are rated from A to triple B. So if you buy bonds of companies that are like small companies, there's a lot more risk of whether or not the bonds are going to get paid off. There's a lot of risk there. So the yield that you get on those bonds is really high. as opposed to like if you buy an Apple bond. Like the odds of Apple going away are about the same as like U.S. Treasuries going away. Like it's not going to happen. So the spread, the difference between buying a Treasury versus buying an Apple bond, you're not getting very much like yield. You're not gaining very much. You may as well buy a Treasury because Apple isn't paying you that much more than a Treasury bond. So you may as well buy a Treasury bond because that's virtually guaranteed, right? But if you're buying, bonds of like S fund companies, they have to pay you a higher yield because otherwise you would go to Treasuries, right? Why would you take the risk?
It's a little riskier, yeah.
Yeah, it's much riskier, right? So the index, this high yield option adjusted spread, is basically telling you when it's going up, the risk on the spread is increasing. So the yield on the bond is going up versus Treasuries, and the higher it goes, it's because the risk is getting higher, right? So the companies have to pay more for you to take on that risk to buy their bonds. So the spread, they call it the spread is widening or the spread is shortening, right? They say the spread is blowing out, right? When they say credit spreads are blowing out, it means the risk is increasing, and so the investor demand is that they get a higher yield to take on that risk, and it happens when the market's going down because companies need you to invest. A bond is a loan, basically, right? You're loaning the company money, so the riskier the environment is, the more rate of return they have to offer you to buy their bonds. And so when the market's going down, the risk goes up because everybody wants to go to Treasuries because that's safe. So companies need to pay you more to incentivize you to go to them instead of Treasuries. So credit yield or credit spreads are another really good indication that the market is getting ready to tank. And it happens before the market starts tanking. So you get credit spreads blowing out, as they say, and the market's going down there. This was 1998. That was sort of a one-off. That was the I can't remember. There was a big hedge fund that failed in 1998. I can't remember the name of it now. But that's what happened. We had that dip in the market, but credit spreads really blew out. I can't remember the name of the company now. They call it the smartest guys in the room. Like unbelievably smart guys that were. It almost brought the whole system down in 1998. So then you can see the opposite also works, right? So credit spreads are going up. We get a peak, and then they start going the other way, and that's telling us that this bottom is in, right? Because now the risk is decreasing, and so even though the S&P is still putting in a bottom there in 2002 into 2003, the credit spreads decreasing is telling us that bottom is going to stay. And then we get, going into a great financial crisis, huge blowout in credit spreads before the market starts rolling over. So you can track that all the way through all these different turning points, and where we are right now, credit is really tight. The spreads are really tight, right? It's not blowing out, but it's really low, right? So the setup is in place, right? All we need to see is credit spreads start blowing out, and then we're going to see the market roll over. So we're not there yet, but definitely something to keep an eye on because, this is a weekly chart, but we seem to be stabilizing there right above 3. And if it turns back up and gets above, say, 3.4, it's probably a problem. So watching to see if credit spreads blow out is another big indicator of which way the market's going to go, or when not which way it's going to go down, but when this thing starts turning up, that's when you really want to get risk off. Okay, initial jobless claims. another good one. So I have actually two charts on that. It's a little bit, I couldn't do it all in one because COVID really messed everything up. So you got initial jobless claims are declining as the market's going up in the late 80s, right? Once an initial jobless claim starts ticking up, that's like the top. So this is a recession. So it doesn't mean that the market has to tank, but we had this recession in 1990 because jobs are decreasing, right? Initial jobless claims are rising. And then 2000, you got a big spike up in jobless claims as the market is topping, right? And people start losing their jobs, and the market goes down. So again, you can do that all the way through. When we go to COVID, it gets a little goofy because if you go back here, the peak up here was 670,000 initial claims, right? COVID is 5.7 million, obviously because everybody got put out of work. So it really messes up the scale of the whole thing. So that's why I kind of put it into two different charts. But we're down here right before COVID, which is pretty normal at like 200,000 jobs, right? You can see we're in this band that we came back to, and we just have this huge spike in COVID, right? So obviously for the past, at least going back to, say, 2017, we're in this band with a top at like 240,000. So again, we're not there yet, but this is another one I'm watching really closely. If we get up here to like 275, certainly 300,000, as more initial claims start to roll in, the market can keep going higher, but as this line keeps going up, the market rolls over. And that's really going to be the thing, because if people start losing their jobs, they can't contribute to the 401k. If you can't contribute to your 401k, Apple doesn't get their money. That's the problem with this whole passive investing Ponzi scheme. So if we do have we didn't have it back here. I mean, we had a big dip in COVID in the market, but it wasn't systemic because the government made sure that everybody had money, and so the passive investment kept going. But if we get another, not a spike like COVID, but if unemployment starts ticking up, the market comes down. But we're not there yet. So in the big picture, all the red flags are there. In the short term, we're not going to talk about the short term charts today, but in the short term, yeah, the market's going up. All right, TNX. It's just the most important chart, I think, and I keep saying that, but we bottomed. This is a 40-year bottom in bonds, in yield rather, and since the bottom there in 2020, we've gone up in this 1, 2, 3, 4, 5 Elliott wave pattern in yield. So bond yields or interest rates have been going up. We have this, so we put in a top, and we had A, B, and we're looking for a C, right? So rates topped out at about 5% last summer. They came all the way down to below 4%, and then headed back up throughout this year, right? But it happened in a corrective pattern. It's not impulsive. So if it was impulsive, you'd have like a 1, 2, 3, 4, 5, right? So we're not seeing that. It's corrective, which means the next move from a corrective pattern is down. And so if the length of A equals the length of C, we should get down to about 3.5% interest rates. It can go lower, but this would be a really good corrective pattern, and then they start going higher. So in the big scheme of things, the chart is telling us that interest rates are going to go much higher, but in the relatively short term, they're definitely coming down, and we know that because the Fed's telling us that at some point they're going to cut rates. The reason this is kind of important is because if you connected this trend line, again, it's a weekly chart. So if you connect the bottoms, this week we had a breakdown. So we should start to see rates coming down, right? And this is kind of a zoom in of it. If rates are coming down, this is what we put up last week, okay, and this is where we were at the end of last week. Now this is where we are. So it looks like it's a cascading down, right? It looks like rates are going to start dropping like they are. This is the 10-year yield, but interest rates ought to start dropping any day now. And this is it's like a waterfall, right? They say that the market goes up in an elevator and down, up an escalator and down an elevator. This is a big deal, though, I think. So if the week closes out down there and that trend line is broken, yields come down, which means the F fund goes up. So this is actually the F fund, right? Aggregate bond index, and it's the inverse of what we just looked at, because when yields go down, the price of bonds go up, and that's what the F fund is. And so we're breaking above that trend line. If it stays there, if we close the week above that trend line, I don't know that I would give it all that much more time before I would get into the F fund, especially if the stock funds start rolling over.
And maybe not like 100% of your portfolio, right?
Yeah.
You could get in there if you see that it's obviously broken a trend line. The trend is up, right? So we're always trying to be on the side of the trend, right? In if the trend is going up, out if the trend is going down. And so to Jerry's point, but I just want to throw it in there that that doesn't mean necessarily you throw your whole basket in there. Right. You could spread it out a little bit. If you see the C fund still going up, the trend is up, F fund's going up. That does happen.
Yeah, absolutely.
It's not really supposed to, right? Because bonds are supposed to be going down when stocks are going up. But the world has changed in the last few years.
It certainly has.
So
the reason that the F fund is so important for me right now, from my perspective, this is bond investors, I think, worrying about the stock market. You won't know that until if bonds do start to explode to the upside and stocks roll over, then you'll know. Because right now they're both moving higher. So you want to be in the stock funds because on a percentage basis, the stocks do better than bonds. So if they're both going up, you're better off in stocks because you're making a better rate of return. But if bonds start going up because people are fleeing stocks and they're looking for the safety of bonds, if that's why bonds are going up, then yeah, you definitely want to be either in the G or the F funds. Okay, so monthly candles are really important to look at because it's easy to get sucked into the day-to-day, what's happening. So on all these charts, forget about the last candle because that's the first couple days of June. So just forget about that last candle. But May, right? May was a huge outside candle, right? It engulfed just barely, but it did engulf the whole range of April. So even though April was really volatile, and it was definitely April was a negative engulfing candle from March, but May turned right back around and got us back to the top. So now we're at a 3-month resistance level right there at the top. So if June can break and can close above, this level, the bull market continues. Obviously, we're in a bull trend, right? So if the market's going up, the bias should be to the upside until it's proven otherwise. And for right now, very clearly in the big scheme of things, the market's going up, right? You would have said it's going down on this candle, right? Maybe that candle, right? The market was clearly in a long-term uptrend, and that if you did that channel, it was broken on that candle right there. So we're not seeing that right now, right? The market's going straight up. We've been consolidating for 3 months. The bias has to be that it moves to the upside from there. Okay. S fund, nowhere near as bullish a chart as the C fund, right? S fund peaked back here in 2021, and it really isn't. is not looking like it's going to get back there anytime soon. I mean, we had a big move to the downside, and we have this corrective-looking pattern right now. It's not impulsive. Impulsive would be, a 1, 2, 3, 4, 5. We're not seeing it. It's just kind of dribbling along, and so it looks like the next direction to the S fund is down. So I'm not as bullish on the S fund as I am on the C fund, or the chart doesn't present that. I fund looks much better than the S fund, right? We're bumping back up against, we got a lot of resistance there at about 80. Tried to get above it last month, couldn't do it. We'll see what happens this month. But there's a lot of resistance there at the prior high. If we can get above it, if we close up here, let's say it's 84. We won't get that high this month, I don't think, but let's say we closed up there at 84. Now that 80 level should be really good support. So if price comes back down, it should get support there and keep going higher. Anytime you can make trading decisions based around really strong support and resistance levels, it's the lowest risk decision that you can make, because if we get up here to 82, 83, let's say, and you buy the I fund, no problem, because if it comes down and closes below here, you're going to sell it because the support has failed. You're expecting the support to hold, which it should hold, right? But if it doesn't, this is your risk. But the potential upside is huge. So that using support and resistance levels to make reallocation decisions is one of the best things about technical analysis. And the F fund, this setup it's not there yet, but it's really, really good. This down move in bonds hasn't happened in like 300 years. So this is a huge, huge move to the downside for bonds. And it's been there for a long time, right? This is 2020. Middle of 2020 was the top in the F fund. And we came down in this 1, 2, 3, 4, 5. So this is what I mean by impulsive, right? This is the 3 wave is how you know that you're in an impulse wave. If this had done A, B, C, right, and and then started going higher, this is a corrective wave. You know it's impulsive when you have this big 3 wave. And the implication from that is that once you bottom out, right, you get an A, B, C correction from that, and then it starts going down again. So this is the F fund on a monthly again, right? So what we're looking at is if this is a major, major bottom, then this is either going to be, it should be an A, B, C, right? So we should get up here somewhere eventually in the F fund, but it will probably correspond with a decline in stocks. So that's why the F fund is so important to watch right now. You can also call this a reverse head and shoulders, right? It's going to be the left shoulder, the head, and the right shoulder. And if we get a break in that neckline, so if we get up here, $100, the round numbers tend to provide some support and resistance also. So certainly if we get above this level, that's why 100 is, if we get up here, the F fund's moving higher. So there's a lot of things to watch. This is kind of a more of a macro view than a closed-end view, but the market's going up until it's not on a day-to-day or a month-to-month basis. But there's a lot of red flags out there right now and a lot of things to watch. So it's not like you're in the dark. There's definitely indicators that can show you the long-term direction or change in the market. And those are, if you're trying to avoid the 50% drawdowns in your TSP, those are the indicators that you want to pay attention to. That's it.
All good stuff, man. I like talking macro every once in a while. It seems sometimes we get kind of zoned in on the daily and the weekly, but you got to pull back and look at the big picture. And I think particularly when we're talking about retirement accounts, because you're looking at a 20, 30-year haul, the big picture is sometimes more important than just focusing on what's going on day to day. If you guys have any questions, feel free to put them in the comment section wherever you found the video. We do our best to keep up with the comment sections. If for some reason you don't have a comment section, you can shoot us an email. support at growmytsp.com, and the support team will get it over to us, and we'll take a crack at it.
All right.
If you guys like it, please tell your friends, share it with your friends. If you don't, share it with it anyway.
They're going to like it, even if you don't.
All right, guys, have a great week. We'll see
Outta
you.
here.